Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture, and we are zooming in on the latest on the Singapore economy, where we have a raised growth forecast for 2025. And that's on the back of a better than expected performance in the first half of the year. But look out for what's coming up in the form of the impact of tariffs. So let's talk about that raised forecast, now at a range of 1.5 to 2.5%, up from an earlier 0 to 2% range. So that's what we have on the table. And to help us unpack that, we've got Barnabas. He is the Group Chief Economist and Head of Market Research for RHB Bank. Barnabas, good morning. Thanks for joining us.
Good morning, everybody.
Hey, let's unpack what we have right now in terms of the raised forecast. So what's worth noting, I think, is now we have 1.5 to 2.5%. Previously, it was a bit lower, 0 to 2%, and that's also a wider range. So we now have a narrower range. What do you interpret from the signal that you are getting from this growth forecast?
I mean, generally, given that we are seeing a resilient economy across most advanced and regional economies, that essentially could have led to a stronger, an upgrade of the range forecast by the Ministry of Trade and Industry. And this is probably a reaction to also, the improvement in the external front in Singapore as well. But I just want to take this, chance to maybe cite a message of caution right here. I think we have to understand that a good part of the strength that we are seeing in the first half of the year, especially the first quarter, has been led by the front-loading behavior whereby trading partners of Singapore or maybe for ASEAN have tried to mitigate tariff risk via front-loading behavior into the US, and that has actually led external strength across ASEAN, including Singapore. Now that we have clarity over tariffs, we have clarity over what Trump may do, hopefully that could mean that, one, there may be some normalization down back to where it first was, but more importantly, I think we should start to price in some payback, whereby the exporters will start to account for the strength that was seen in the first half and react to potential lower demand that may be seen in the second half of the year.
Okay, let's unpack a couple of things here. First, let's talk about the first half versus the second half and look at the first half numbers. And that's where we had the better than expected 4.4% growth in the second quarter, which followed the 4.1% gain in the first 3 months. What sort of slowdown are you looking out for in the second half of the year?
Oh, there's so many areas to be worried about. I think maybe first key thing, maybe if I could just, introduce something called 3 T's. The first T perhaps is tariffs, whereby we are still waiting for clarity, between US and India. The deadline is on the 28th of August. I know that there is further delays of US and China, this negotiation for 90 days, but I don't think they're out of the woods just yet. So that's a tariff front. We are still waiting for, say, the tariffs on the industries like semiconductors and pharmaceutical, and these are key pillars for Singapore. Second is geopolitical tensions, and last but not least, probably it's the potential, the US Fed that may not cut rates as fast as we want, so it's tighter than expected. The last T, monetary policy that could actually be on the cards.
Okay, so a couple of T's to watch out for. Something to watch out for as well is the upside potential. So here's where your forecast comes in. So we have the official forecast, 1.5 to 2.5%, but your forecast right now is pretty much sitting in the middle of it, 2%, with the upside potential to reach 3%. So it's sounding a bit more optimistic than the official forecast. What will help it to reach that 3%? What signals might prompt it to be revised upwards?
I think maybe just 2 key reasons. First and foremost, we have to account that the first half of the year grew and expanded very well. It's above 4%. So this essentially means that if we do rely on the official forecast of a range of 1.5 to 2.5, midpoint at 2, that basically translates from the statistical point of view that the second half of the year has to come in at 0% in order for the MPI forecast to be reached between 1.5 to 2.5 or lower. We think that may be something that could be accounted for. If that happens, basically it it's a scenario whereby tariff risk magnifies into the second half, plus the fact that there's further digestion of tariff effects into the second half of the year. We think that may be a little bit too bearish, although we do agree with a 2% handle, given that we are still cautious about potential tariff risk in the second half. But bereft of tariff risk that could happen, then that may actually lead to a upside risk towards 3%.
Okay, let's talk about the sectors in Singapore that are bright spots in the latest second quarter. I'm looking at construction, year-on-year growth, 6%, manufacturing up 5.2%, real estate is up 5.2%. Will these sectors continue to get momentum in the coming quarters? What are you looking out for?
Yeah, I think maybe we should have a sense of caution, especially in the second half. As I mentioned, in the earlier part of the interview, a lot of it is due to front-loading behavior, manufacturing, and of course, if we look at the other, the strength in wholesale trade, financial services, these are all external-facing industries, and if there is going to be a tightening of credit conditions, if there are going to be a slowdown in trade, then we can safely assume that external-facing industries will take a notch down in the second half of the year. I think perhaps maybe some cushion could actually come from, say, the construction because it's domestically inclined, but also I think we are seeing an encouraging trend of improving tourism into ASEAN, including Singapore. That could actually be one of the cushions for, say, the retail trade, and could lead to improvement in domestic consumption as well, and that may mean that hospitality-related services might be something that could cushion the slowdown in external industries. Okay.
Are you seeing any warning signs in terms of how businesses are already adjusting? I'm seeing some reports, for example, this morning, Ninja Van cutting 12% of their workforce. Yeah. Are you seeing perhaps more layoffs on the cards with all that's playing out in terms of uncertainty, tariffs having an impact? What are you seeing?
If we look at this job cutoffs and layoffs and stuff like that, I mean, as an analyst, we tend to get worried, I must say, whereby we might start to assume that companies may be reacting to a further slowdown in global and domestic conditions. But I think maybe a word of let's look at reality right here. I mean, things are looking better with the tariff clarity. Things are looking better, especially when there is a US and China trade negotiations. So this is from the global perspective, yeah. It is no surprise that domestic companies may start to take a cautious, stance given the slowdown, the potential slowdown in the second half. But the thing is that a longer-term prognosis or paradigm perhaps may be something that we should look forward to, which is a positive one.
All right, for now, some optimism. Hopefully, we do get more clarity as well in time to come. And we've been in conversation with Barnabas Gan. He is the Group Chief Economist and Head of Market Research at RHB Bank. Thanks for your time and chat to you again soon.
Thank you so much.
All right, save us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.